In the last class, we were discussing about the different types of risk. We came to understand that risk can be of two types. There is systematic risk as well as unsystematic risk. Systematic risk is caused due to external factors and these are beyond the control of the businessman. Unsystematic risk is caused because of internal factors which are company specific or firm specific and is controllable to a certain extent. So before we move on to the measurement of risk, we need to understand the measurement of return, which is an important factor to be considered while we are measuring risk. So we know that return can be in two ways. If you are investing in a security, if you are investing in an equity share or a preference share, then your return is going to be in the form of dividends at regular intervals and also in the form of capital gain at the time of selling the security. So to measure the return, there are two formulas. You can apply any formula to identify a probable return for your security. What could be the return if you are investing in a particular security? That is the probable return. So the first one is income received plus price change divided by purchase price of the asset. The income received is the dividend. The price change is the difference between the price at the end of the year as well as the price at the beginning of the year. The beginning of the year price means the initial investment that you made, the actual price you paid for that security is known as the price at the beginning of the year or P0. Now it should be divided by the initial investment or price at the beginning of the year or the actual amount you spent to purchase that security. That is the P0. So the first formula is the income received plus price change divided by purchase price of the asset. Can also be symbolized as D divided by P0 plus P1 minus P0 by P0 into 100. The second formula is the forecasted dividend, that is the expected dividend, plus forecasted end of the period stock price. In the first formula, you took the difference between the sales price and the purchase price. But in the second formula, you're only taking into consideration the selling price or the price at the end of the year. That is a forecasted end of the period stock price divided by initial investment, that is the purchase price. Minus 1 into 100 will give you the return. So to be more clear, we look into a problem. Suppose a share is currently selling at rupees 120. That is your purchase price. You're going to purchase that security for rupees 120. That is the price at the beginning. Now, an investor who is interested in the share anticipates that the company will pay a dividend of rupees 5. That is the income. That is the D value in the equation, the dividend. Moreover, he expects to sell the share at rupees 175 after 1 year. That is the end of the year price. So you have got all the data to calculate the probable return for your security. According to the first formula, we should calculate the dividend divided by the initial price, that is the purchase price, plus the difference between the end price and the starting price, that is the selling price and the purchase price, divided by purchase price into 100. So going to the question, the dividend is 5 rupees. So 5 divided by the initial investment or the price at which you bought it when it was sold for 120, that is 120. So 5 divided by 120, that is D divided by P0, plus P1 minus P0 by P0 is the next part of the formula. P1 is the end of the year price, that is if you are going to sell your security, the selling price which is currently available in the market is rupees 175. So P1 is 175 minus P0, which is the initial price, that is 120, divided by 120, which is your initial investment, into 100 will give you. You could also write this as 5 plus 175 minus 120 is 55. So 5 plus 55 divided by 120 into 100, which will give you 50%. So if you're investing in this particular security, you could probably get a 50% return from that investment. The second method is we will calculate the dividend plus the end price. What was the price at the end? Divided by the price at the beginning or the initial investment minus 1. So taking that formula into consideration, the dividend is 5 plus the end of the year, the price or the current price is 175 divided by the initial price that was 120 minus 1 will give you 0.5. That into 100 will give you 50%. So whichever formula you apply, you're going to get the same result. So you could follow either the first formula or the second formula depending upon the data which is available in your question. Okay, so we learn to calculate a probable return from the with the help of the initial price and the end price and the dividends. But there is always a risk element involved. We cannot assure anyone that the actual return that we get would be 50%. It could vary. So it is always advisable to go for a set of probable returns. You could always choose that you could get 50% return, or it could go down to 40% or 30%. Yeah, and in the same way, it could rise up to 60% or 70%. So when you're calculating your rate of return, calculate a set of returns. That is, you could go to 30%, 40%, 50%, 60%, or 70%. And then you could go around putting a probability for these possible returns. That is, probability could be anywhere between 0 and 1. It could be 0.10, it could be 0.30, it could be 0.40. The return which is most probable, that is the return that you're sure that you will get, then you can give it as probable as 1. If you're sure that you're not never going to get that return, then the probability will be 0. So the probability will always range between 0 and 1. It will never go to a negative value. When you add up the probabilities of all the possible returns, the total should be 1. You'll understand it better when we go to the question. So we're going to calculate the expected return. What we calculated earlier was just the probable return. There was a chance of getting that return. What is the expected return? What is it actually? What can you expect? To calculate that, there is a formula. The expected return is the sum of the products of possible returns with their respective probabilities. That is, it is a probability weighted average of all possible returns. I know you won't understand anything if I keep saying the formula. Let's move on to the question and then we'll come back to this and you'll be able to understand it better. See, the possible return when we calculated was 50. Always keep in mind, this is not the price, this is the rate of return. This is a percentage of return. Okay, so in the question, check whether the first column is given in percentage. If it is given as actual price, you need to convert it into percentage. So the percentage value that we calculated is 50%. So you're getting 50%. You said it go down to 40, it could go down to 30, or it could rise up to 60 and 70. Now we have assigned probability values. This has already been given in the question. So you will not be asked to calculate the probability. It will be given in the question. So in this particular case, let's assume that the probability is 0.10, 0.30, 0.540, 0.10, and 0.10. Always note that when you add up these probability values, the total value that you get will be 1. That is, 10 plus 30 is 0.40 plus 0.40 gives you 0.80 plus 0.10 plus 10 will give you 1.00, which is nothing but 1. Now, coming to the expected return. To calculate the expected return, you have to multiply the possible return with the probability and then take the total. That is, 30 into 0.10 will give you 3. 40 into 0.30 will give you 12. 50 into 0.40 will give you 20. 60 into 0.10 will give you 6. 70 into 0.10 will give you 7. Now add up all the values in the last column. 3 plus 12 plus 20 plus 6 plus 7 will give you 48. That is your expected return. That is, if you're investing in this particular security, you can expect a 48% return out of it. So thereby we arrived at the calculation of the expected return. Now let's go back to the explanation and see whether we can understand. What is expected return? It is the sum of the products of possible returns with their respective probabilities. That is, we are multiplying the possible returns with the probabilities, and then we are taking the total of that. Products of the possible returns with respective probabilities. That means we are multiplying the possible returns with the probabilities and then taking the sum of it. So we can say expected return of the investment is the probability weighted average of all possible returns. I hope now that explanation is more clear to you. So the formula given is X bar. I have denoted expected return as X bar. X bar is equal to sigma Xi into P of Xi. Sigma Xi is the possible returns. P of Xi is the probability returns. When we multiply both of this and take the sigma, that is the total, you will get the expected return, which is 48. Now we'll start explaining how to measure the risk. There are various statistical tools to assist you in calculating the risk. Some of it is variance, standard deviation, beta value, etc. Now, the standard deviation is the most widely accepted or popular method of calculating your total risk. I already explained that the risk consists of systematic risk as well as unsystematic risk. See, unsystematic risk is company specific or firm specific. So you can reduce your unsystematic risk by managing your portfolio efficiently. You could choose different type of firms so that the risk is diversified and we can bring that unsystematic risk to almost -0 level. So unsystematic risk can be eliminated through diversification, through an efficient portfolio. So what we need to concentrate in is systematic risk, which is beyond the control of the businessman. Two methods which is being adopted for calculating the systematic risk is correlation method and regression method. In correlation method and regression method, we will calculate the beta value. Beta value is nothing but the measurement of the systematic risk in your investment. So beta is the value that is used to determine the systematic risk. Now the beta value could be 1, it could be less than 1, it could be more than 1. Beta value 1 means there is average risk involved. Higher the beta value, higher the risk. That is what we assume. And lower the beta value, lower will be your risk. So if your beta value is negative value, it means the security is having a high risk. And if the beta value is a positive value, which is more than 1, then it means that the security is having only an that is I'll explain once more. If the beta value is 1, it indicates that the asset has got average risk. If the beta value is greater than 1, then it means there is more risk. And if the beta value is less than 1, the risk is below average. So lower the beta value, it is better. Higher the beta value, it means your security has higher risk. So the various measures of variance and standard deviation, both of these are used to calculate the total risk. Then you can calculate the beta value to calculate the systematic risk. Correlation method and regression method is used to calculate the beta value. Moving on to the next slide. Let's now look into a problem. See, the formula to calculate the variance, that is sigma square. Variance is denoted with sigma square. I have taken this page out of S. Kevin's textbook. It must be available in your textbook also. Kindly find out the question. So sigma square is equal to sigma, the total of xi minus x bar square into P of xi. Don't get confused with all the formulas. Let's look into the problem so it will be more clear. To calculate the expected uh, return, you already know. We have already calculated the expected return as 48% in the previous question. So keep that in mind. This is just a continuation of that question. See, the possible returns is 30, 40, 50, 60, 70. The probability is 0.10, 0.30, 0.40, 0.10, and 10. Now we need to calculate the deviation. How much is the actual, this possible return from the calculated expected return? So 30 minus the expected return is 48 as per the previous question. So 30 minus 48 gives you negative 18. 40 minus 48 gives you negative 8. 50 minus 48 gives you 2. 60 minus 48 is 12. 70 minus 48 is 22. So you found the deviation. Now you know there are some negative values in that. We need to eliminate the negative values, and the best way to do it is to square that value. So negative 18 into negative 18 will give you 324, which is a positive value. Minus 8 into minus 8 will give you 64. 2 into 2 gives 4. 12 square 144. 22 square 484. So you square the deviations. Now what you do is you will multiply it with the probability value. 324 into 0.10 gives you 32.4. 64 into 0.30 gives you 19.2. 4 into 0.40 gives you 1.6. 144 into 0.10 gives you 14.4, and 484 into 0.10 gives you 48.4. It is nothing but the deviation square into the probability value. Now calculate the total, you get the variance, which is the sigma square. 116 is the value. To arrive at the standard deviation, you know it is always the square of the variance. Standard deviation is nothing but the square root of variance. So you calculate the square root of 116 and you calculate the root of 116, you will get 10.77%. That is the risk element involved. Okay, so that is with regard to the measurement of the risk. You have all now, I hope you have understood how to calculate the variance and the standard deviation, which will give you the value of the total risk. So there is a risk of 10% in your investment. 48% return is what you expect, that there is a 10% risk involved in your investment. Now let's go into some of the illustrated questions. The first question in your textbook is, a share is currently selling at rupees 50. It is expected that a dividend of rupees 2 per share would be paid during the year, and the share could be sold at rupees 54 at the end of the year. Calculate the expected return from the share. So you have got all the values. You would calculate your expected return. This is just a single share or security. So as per the formula that we applied at the beginning, the expected return is the forecasted dividend plus forecasted end of the period stock price divided by the initial investment minus 1. So the dividend is rupees 2 plus at the end the price is 54. So plus 54 divided by the initial price, which is nothing but 50. Minus 1 will give you 0.12, that is 12% returns. Now we could apply the other formula also, where we calculate the dividend by the initial price plus the price change, that is the end of the year price and the beginning of the year price, divided by beginning of the year price. So 2 by 50 plus 54 minus 50 divided by 50, which will also give you the same result, 0.12 or 12%. So applying both the formulas, we'll get the same answer to calculate the expected return. That was when the probability was not given. See, in the question, the probability values were not given. You were only given the dividend rate, the initial price, and the end of the year price. In that case, the only formulas you can apply is these two. Let's look into the second question. See, calculate the expected return and the standard deviation of return for a stock having the following probability distribution of returns. So in this case, You are asked to calculate the return as well as the risk. Standard deviation of returns is nothing but risk. So you have to calculate the risk and the return of this investment. So they have given a range of possible returns. Check whether the possible returns is given in percentage. If it is given in percentage, all you have to do is multiply it with the probability and take the total to get the expected return. If the possible returns is given in price, then you will have to do further calculations to arrive at the percentage value. Okay, so in this question, they have given it in percentage. So you just have to directly apply what you learned. See the possible returns, the probability, you're going to multiply negative 25 into 0.05, which will give you minus 1.25, negative 10 into 0.10, which will give you negative 1, 0 into 0.10 gives you 0, 15 into 0.15 gives you 2.25, 20 into 0.25 gives you 5, 30 into 0.20 gives you 6, and 35 into 0.15 gives you 5.25. Take the total of that, that is 16.25 is your expected return. Now you need to calculate the standard deviation of the risk. To calculate standard deviation, you have to find out how much these possible returns deviated from your expected return, which is 16.25. So minus 25 minus 16.25, basic mathematics, the negative and negative value gives you the sum of that value. So minus 25 minus 16.25 gives you 41.25, minus 10 minus 16.25 gives you 26.25, 0 minus 16.25 gives you minus 16.25, 15 minus 16.25 gives you 1.25, 20 minus 16.25 gives you a positive value which is 3.75, 30 minus 16.25 gives you 13.75, and 35 minus 16.25 gives you 18.75. Now to eliminate all these negative values, we are going to square these deviations. This is the squared values. Negative 41.25 into negative 41.25 gives you 1701.56. Likewise, you're going to square all the deviation values and you can fill the fourth column. Now moving on to the fifth column, it is nothing but the product of the squared deviation with the probability values. So 1701.56 into 0.05 gives you 85.08. 689.06 into 0.10 gives you 68.91. Likewise, you are going to multiply all the squared deviations with the probability values and then take the total. The total is the sigma square or the variance value, which is 274.69. Variance also denotes risk, but you have been asked to calculate the standard deviation in the question. So to arrive at the standard deviation, find the root of 274, which is the root of the variance, and you will get 16.57% as the risk involved. This is how you calculate the return and the risk. Now the third question, a stock costing rupees 120 pays no dividend. The possible prices that the stock might sell for at the end of the year with the respective probabilities as follows. See, they have given you the price, different prices which is expected and the probability values of that price. There is no dividend. They said only the price is there. There is no dividend involved. So we need to calculate the percentage of the possible prices. This is just the possible prices. The question given is the actual price. You need to calculate the percentage value. So then only you can arrive at the expected return. So the possible prices they have given 115, 120, 125, 130, 135, 140. You're going to calculate the percentage returns, the percentage probable returns. To do so, we have to calculate the formula. D by P0 plus P1 minus P0 divided by P0. We know that D is 0, so you can eliminate that first part of the formula because there is no dividend given. Now, P1 minus P0 by P0 is what you need to calculate. Okay, so P1 is rupees. What is the price at the end of the year? Okay, the initial price is 120. The end of the year price is going to keep on changing. So end of the year price is 115 minus P0 gives you 120. That is 115 minus 120 gives you negative 5. 120 minus 120 gives you 0. 125 minus 120 gives you 5 because P0 is always 120. The P1 is the different prices given in your question 115, 120, 125. Okay, so P1 minus P0 means 125 minus 125, 130 minus 120, 10, 135 minus 120, 15, 140 minus 120, 20. Now P1 minus P0 divided by P0, that is 120 again into 100. So this negative 5 divided by 120 into 100 will give you negative 4.17. Likewise, you're going to calculate all the values in the third column. The last value is again 20 divided by 120 into 100 will give you 16.67. So you have got the percentage of returns, percentage of probable returns. So now we are going to calculate the expected return. The probable returns are negative 4.17, 0, 4.17, 8.33, 12.50, 16.67. Probabilities are all given in the question itself. You just copy that to the second column. The third column is the product of the probable return and the probability. That is negative 4.17 into 0.1, 0 into 0.1, 4.17 into 0.2. After calculating the products, you have to calculate the sum of it, which will give you 7.083. So we have calculated the first part of the question. Calculate the expected return, which is 7.08%. Note that in the question, the prices were given. That is why we needed to calculate the percentage of possible returns. Then we arrived at the expected return. Now the second part of the question is to calculate the standard deviation of returns, which is the risk. So you already know how to do that. You have calculated the probable returns. That is the first column of your table. The second column is the probability. The third column is the deviation from the expected return. The expected return is 7.08. So minus 7.08 from all the values in the first column. 4.17 minus 7.08. Likewise, well, because the first one is a negative value, negative as negative will give you a positive value. Minus 4.17 plus, sorry, minus 4.17 minus the expected return will give you minus 11.25. Likewise, you're going to calculate the deviation. To get rid of the negative values, you are going to square it. The squared value is given in the fourth column. And the last one, it is nothing but the product of the deviation square and the probability. 126.56 into 0.1, 50.13 into 0.1. Likewise, you're going to multiply all the values. When you take the total of the last column, you're going to get the variance, which is sigma square, 34.91. Find the root to calculate the standard deviation. The root of 34.91 is 5.91%. And that is how you calculate the standard deviation. I hope that much is clear. There is also the calculation of beta value using the regression method and the correlation method. And there is also another type of calculating the expected return. There's a different question, the next exercise question and the next illustration question. You can look through it if you want, but we'll discuss it in the next class. See, questions to calculate using regression and correlation method is not so common. That is why I'm not explaining it in detail. Next class, I will just give you a brief explanation about that part. I hope this is clear to you to calculate the variance and the standard deviation and thereby arrive at the risk percentage, and also to calculate the return from a question. Thank you.